Welcome dividend investors. In this video, I'm going to answer which dividend stock is the better buy, Coca-Cola or Deere and Company. I'm going to look at a few different metrics to answer that question, starting with the dividend yield. Of course, that's one of the more important things dividend investors look at before making an investment. Coca-Cola offers a dividend yield of 2.77%, and Deere and Company offers a dividend yield of 1.05%. I know that dividend yield might be low, but don't count this company out just yet. The next thing I want to look at is the dividend payout ratio, and here is why I say don't count out Deere. Coca-Cola is paying 57.68% of dividend payout ratio. What this means is that Coca-Cola pays nearly 58% of its earnings out in dividends, right? Meanwhile, Deere pays just 18.41% of its earnings in dividends. That means that Deere has greater room to grow its dividend over time than Coca-Cola does, because Coca-Cola is already paying such a large share of its earnings as dividends. That's why I said don't count out Deere, because Deere has room. Even though it's just 1% now, that doesn't mean the 1% dividend yield is permanent if you invest in the company now. Companies usually that pay a dividend usually grow it over time. And so if you invest in Deere stock now with a dividend yield of 1%, you may find that 5 years down the road, that dividend payment has increased meaningfully. And so if you compare your price you paid compared to the dividends you're getting 5 years from now, that makes it seem a lot more lucrative. So don't count it out just because it's 1%. So let's move on. The next thing I want to look at is the quarterly revenue growth year over year for these two companies. And longer term, these companies are not known for fast growth, right? These are flat-ish, mature companies that are growing sales less than 10%. I would say in the mid to low single digits is what you can expect from these companies longer term. But over the recent few quarters, they've been growing really fast. Deere had one of its fastest growing quarters ever at 36% in its most recent quarter. In fact, Deere has a long backlog of orders from dealers and farmers that want to buy its equipment. It's having a hard time fulfilling those orders because of supply chain shortages and logistic issues, costs of goods, and all of that. But meanwhile, Deere's got record revenue, so it likes where it's at, right? It likes that it's got this whole backlog of orders. Customers are waiting for it to deliver, and it's taking, it's cautiously ramping up production to meet that increase in capacity. And with commodity prices soaring, that's only increasing demand for its equipment, and it's actually in an innovative period of where it's infusing technology in its equipment. That's really causing an increase in demand. So Deere's in a really good position, but so is Coca-Cola. Coca-Cola struggled during the earlier stages of the pandemic because it's got a greater percentage of market share in channels where consumers consume its products away from home. Think of restaurants, theme parks, ball games, sports complexes, movie theaters. Coca-Cola spent decades establishing exclusive relationship with merchants. Think of Coca-Cola's relationship with McDonald's, right? You can't get Pepsi at McDonald's. It's only Coca-Cola exclusive. And so when McDonald's was saying, hey, you can't dine in at our restaurants, and people were ordering McDonald's to take it home, well, you're less likely to buy a beverage from McDonald's if you're going to eat at home, because you probably have soda already in your fridge. But the opposite is playing out now. Now that consumers are unleashing that pent-up demand for away from home experiences, for dining out, for eating at restaurants, now Coca-Cola is benefiting from that trend, and you're seeing revenue explode for Coca-Cola from negative 25% in the first quarter, or really from the first quarter of the outbreak, to it had a quarter above 36%, and even in its most recent quarter, 10% growth. You can't expect this kind of revenue growth for Coca-Cola in the long run, but in the shorter term, over the next few quarters, it could grow pretty quickly as consumers continue to unleash that pent-up demand. Next, let's look at the earnings per share growth for both of these companies in the trailing 12 months. Both of them showing very nice earnings per share growth longer term. Coca-Cola and Deere, both excellent earnings per share growth. Deere may be looking a bit better in terms of the pace of growth, nearly tripling its earnings per share from 8 to over 23. However, I don't know how sustainable this elevated level is. Right now, there's that pent up demand and the backlog. Maybe $16 earnings per share is, if you want to be more conservative, still more than doubling that from 2014. Really good growth here. Next, let's look at the operating profit margins for both operating income and operating profit margin from Coca-Cola and Deere, and both of them showing nice operating income growth. But if we look at the operating profit margin specifically, Coca-Cola is way ahead of Deere and longer term. Also, Deere less than 20% for the longer term. You could say closer to 10 to 15%. Meanwhile, Coca-Cola consistently above 20%, hitting 30% for several for the recent few years, and 28% in its trailing 12 months. So Coca-Cola the advantage in terms of operating profit margin. Finally, let's look at valuation to determine which one is the better buy, looking at the forward PE ratio. Deere trading at a forward PE of 14.8, while Coca-Cola at a forward PE of 23.68. And while I do feel that Coca-Cola deserves a premium valuation over Deere because of its longer duration of achieving much higher operating profit margins, much higher gross profit margins, it deserves the premium valuation. However, I feel that this premium from 14.8 to 23.68 is a little too much of a premium to pay for Coca-Cola. For that reason, I would say Deere is the better dividend stock to buy if you're a long-term dividend stock investor. I know the dividend yield was much smaller, but longer term, you may be able to reasonably expect Deere to increase its dividend per share over the next 5, 10, and 15 years down the line. All right, so there you have it. That's all I've got for this video. Thank you for watching, and I'll see you next time. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now.